Happy Thursday out there, folks. This is Darius Dale here to present our macro minute for Thursday, June 16th, 2022. Starting with asset markets, we have stocks down big this morning, commodities mixed with agriculture leading, crypto down, dollar flat, global bond yields up big. Market moving headline. 3 of the 9 policymakers voted for 50 basis points, the same 3 who dissented last time. Still, the Bank of England hinted it may join the trend for larger rate hikes forcefully, if necessary, in language that was endorsed by all voters, unlike last month when 2 declined to agree that more hikes were needed. The bank also raised its forecast for peak inflation this year to slightly above 11%. The pound fell and UK gilts bonds parrot losses. Number 2, I repeat, the global reduction in liquidity continues. So the SNB, the Swiss National Bank, unexpectedly raised rates for the first time since 2007. Jumping aboard the global bandwagon with a sizable increase of 50 basis points to minus 0.25%. Yes, they were at minus 0.75% on its base rate. It also said that more tightening may be needed and upped inflation forecast. So the whole world's central banks are not the whole world, but many of the world's, including the Fed, trying to right size consumer and business demand in their respective economies to an observed lower level of supply, lower level of labor supply, lower level of food and energy supply, lower level of base metal supply. We're all competing for the same supply out there. And the reality is there's just too much fiscal monetary easing that was pumped into the system over the last couple of years relative to that supply, which itself is not magically created. In terms of the number of people out there that are available for work and the number of goods, physical commodity goods that are in the ground waiting to be extracted. Shifting gears again, all eyes on the Bank of Japan overnight. So the BOJ is under pressure to adjust its policy tomorrow as a slide in the yen tests its resolve to keep yields in check. A tweak to its yield curve control is likely to be met with yen gains and obviously significant BOJ losses. The duration, the DV01 dollar value of 1 basis point move is significantly higher at lower interest rates, which is why we're currently experiencing the worst bond market rout of all time, at least on a global basis and U.S. Treasury basis. The dollar yen 1 week implied volatility is near the highest since 2020, which is why the market is testing the BOJ's resolve here. It's not clear that the BOJ is leading this charge. It's very clear that the Ministry of Finance, which controls the currency market, not controls the currency market, but would be the entity responsible for intervening in the currency market, may be applying some pressure to the BOJ. But again, BOJ Governor Kuroda has been very adamant about not wanting to mess with the yield curve control program, particularly given that Japan just now for the first time in 7 years reached its inflation target on a 1 month basis, and 2, does not have the kind of wage dynamics or wage pressures that would typically get a central banker concerned about a deepening inflation issue in their economy. So, I'm 50-50 on this. I don't think you can have a perfect call or high conviction call for everything. But the reality is if they do amend their yield curve control policy either tonight, overnight, or at any point in time in the next couple of months, it's very likely you see significant declines in bond prices globally, Treasury bond prices, German Bund bond prices, particularly where the rates are the lowest in terms of those deep and liquid markets. And that's partially why you're seeing such a big rout in bond prices today. And then lastly, this is something I think is important to talk about. Buybacks are not the panacea that investor consensus hopes, which, by the way, is not a risk management process. They will be. Goldman's unit that executes share buybacks for its clients, for its corporate clients, saw volume spike to 2.8 times last year's daily average on Friday and more than triple that. So basically 9 times last year's daily average on Monday, both ranking as the busiest of the year at those intervals. So just recall the S&P was down minus 3% on Friday and down nearly minus 4% on Monday, even though buybacks spiked 3 times the daily average on Friday and basically 9 times the daily average on Monday. So what does that tell you? One, they're buying back their shares pro-cyclically, so they're waiting for market declines to execute those trades. There's been a lot of academic work in the buyback sphere that shows that companies that buy back their shares at a discount tend to outperform significantly over the medium and long term than those companies that buy back their shares at market rates or above market valuations. And more importantly, the entire point of buying back your shares is to accumulate as many as possible back onto your balance sheet so that you can reduce the total number of shares outstanding in the marketplace so you can inflate your earnings per share. So it only makes sense for these companies to wait to buy back their shares as opposed to saying, hey, well, the market's down 5 or 10%. I got to protect my stock price. It's not about protecting their stock price in the moment. It's about inflating earnings per share on a medium to longer term basis. And so this is why buybacks, when markets crashing like it is, typically are not the panacea that, again, a lot of investors, a lot of folks who are trapped long. There's a lot of folks trapped long, according to our analysis. Did a big deep dive on that in the macro scouting, latest couple of macro scouting reports. It's not going to be the panacea to bail them out that I think they will be. They will need a different panacea. Big movers this morning, S&P 500 minus 2% to down 8% month over month. Ethereum minus 6% to down 45% month over month. 10-year nominal treasury yield up 13 basis points to up 50 basis points month over month. I'll be the first person to tell you, and our clients know, I spent 6 weeks getting my ass handed to me from mid-February to late March being long bonds. 6 weeks. You know what we did? We said, you know what? I spent about 30 minutes in our Around the Horn presentation waterboarding myself, for lack of a better word, about that bad trade, and we got out of them. And guess what? They're down a whole hell of a lot more in price since then. Sometimes you got to take a small loss before they turn into much, much, much larger losses. A lot of investors didn't pay attention to that signal, didn't get that signal in real time, and that 6 week trade, we were unfortunately long bonds. That's no longer an issue largely for our portfolio. I believe we still do have a TLT in there, but we also have PFIX, simplifies interest rate hedge, offsetting that. It has been offsetting that for much of the year as well. So, we don't think this is the time to buy bonds. We will get an opportunity to buy bonds, and you're certainly not going to get that signal for free on this program. Jumping into our volatility adjusted momentum signals and probable range processes, U.S. dollar index, that is still bullish VAM, still overbought with minus 2.6% of downside to the lower boundary of its probable range. Gold bearish VAM, still in the middle of its probable range. 10-year nominal treasury yield bullish VAMs, overbought with minus 54 basis points of downside. High yield OES neutral VAMs, likely going to break back out to bullish at some point with minus 117 basis points. It's overbought with minus 117 basis points of downside. S&P 500, that is bearish VAMs, that is oversold with 11% upside. VIX, that is still neutral VAMs, that is nearly overbought with 31% downside. NASDAQ 100, that is bearish VAMs, oversold with nearly 12.1% upside. Russell 2000, that is neutral VAMs, likely to break back down to bearish. That is oversold here with nearly 14.7% upside. Bitcoin bearish VAMs, deeply oversold with 40% upside. Ethereum bearish VAMs, deeply oversold with 56% upside. Again, we're not saying they're going to get to the upper boundary of the probable ranges. That's just where the current math shakes out at the current juncture. Shanghai Composite neutral VAMs likely to break out the bullish VAMs shortly with it's still nearly overbought with minus 4.6% downside, 1.4% upside. WTI crude oil, great spot to be allocating to crude oil here, unless, of course, you're making the call that we're about to go into or already in a global economic recession very soon. And at which point would obviously not be a great place to be buying crude oil because it tends to get washed out in recessions. But that's not necessarily our call here. It's not our base case scenario in terms of a very near-term recession. So that means we're oversold here within the context of a bullish VAMs. Great buying opportunity here with 14% upside to the upper boundary of its probable range. And then lastly, ag neutral VAMs still minus 2.2% of downside versus 4.1% of upside. Bearish VAMs industrial metals, that is oversold with 8.7% of upside. So with that, Darius Dale presenting our macro minute for Thursday, June 16th, 2022. Best of luck out there. And oh, by the way, luck is not a risk management process. 42 macro is.